Good evening. Thank you for joining. Today's topic is about OECD, which is Organization of Economic Cooperation and Development, which is a intergovernmental organization formed by more than 140 countries together. The intention is that there is a uniformity of taxation, and they want to have a fair play is made on tax collections and in getting the revenue for each country so that one doesn't have a favor of over the other country. So the 140 countries governmental officials will be involved in making the policies and decisions. So they have come out with Pillar 1 and Pillar 2, which I'm going to tell you in detail later. I also would this having headquarters at Paris, France. Another institution called FATF. FATF is Financial Action Task Force. It's also an intergovernmental organization founded in 1989 on the initiative of G7. You know, G7 countries are there in the world to develop policies to combat money laundering and terrorism financing. The secretariat for FATF is also in Paris, but both are two different organizations. The FATF has got 40 member countries. In fact, OECD has got 140 countries, as I was mentioning you earlier. What is the role of FATF? They have come out with 40 recommendations earlier. The main purpose of this FATF is to combat money laundering, terrorism financing, proliferation financing. I was telling you earlier what is proliferation financing is financing for where people built up factories to have arms and ammunition. So to avoid the financing of that activity, other than it's governmental in nature. So they have come out with 40 recommendations. You know about that 40 recommendations, which is concerned with about taking KYC of people whom you are going to work for to avoid the money laundering and countering finance of terrorism. Also, that has come out with what are all red flag activities so that any corporate service providers or people carrying out an audit of a company have been trained and made to know the customer, know your customer, and to combat money laundering and financing of terrorism activities. FATF also has come out with recommendations where the companies create internal policies and procedures, IPPC they call, and control, whereby you laid out the policies, process, and procedures in your organization, train your staff to understand the IPPC. This is nothing but how do you, when any customer comes into you, how do you screen the customer for KYC requirements? How do you decide on the activities you are going to have with the customer? How do you train the staff to identify these customers? And also, how do you recruit the staff and train the staff on an annual basis? Singapore also, in line with the recommendation of FATF, has come out with with the new act called precious and semi-precious, precious stones and precious metals, Prevention of Money Laundering and Terrorism Financing Act of 2019. The intention is that when any company is going to deal in precious and semi-precious stones, should have a process and procedures in identifying the customers and dealing with the customers. That's the reason why the IPPC was introduced. And Singapore has enacted a law. It's called PSPM Act of 2019. The intention is that if you're going to deal with people who are going to come buy precious metals or precious stones, how do you engage them? If it is more than $30,000 of cash transaction take place, it is the duty bound of the shop owner to report to the suspicious transaction reporting office. So that is the role of FATF, and I'm going to talk about the role. Now today's topic is on OECD, which is about Organization of Economic Cooperation and Development, Pillar 1 and Pillar 2 regulations, which we'll go into. Before we go into the OECD Pillar 1 and Pillar 2, the intention of the Pillar 1 and Pillar 2 is that they would like to engage countries to come out with taxation rules so that multinational enterprises which operate in those countries make a fair share of tax whenever they operate and generate profits in their respective jurisdictions. When I say multinational corporations, usually companies of big nature, they always operate in various countries. They will have various countries operations, and then they'll have headquarters in one jurisdiction. The tax planners always recommend the tax loopholes legally to avoid, and OECD is trying to tell them how do you make the multinational corporation to pay a reasonable tax in the respective countries they operate. That's the purpose of this OECD Pillar 1 and Pillar 2. Why they only look at companies which are multinational in corporations in nature? The reason is that even it's a big company, if it is stationed in one country, they are not taking advantage of various countries' tax regulations. That's the reason why they've not looked into. Even though you are very big in operation and you operate in only in one country, they are not concerned because you are concentrating your operations in one particular country. But multinational corporations operate in various countries. I give you a very interesting example. Ireland, what happens is in Ireland, most of the American companies have got their operations. If you look at the Magnificent Seven companies they talk about in the US, in the stock market, they form more than 54% of the S&P index. And which are the Magnificent Seven companies? It's all Microsoft, Google, they call Alphabet, Tesla, then you got Nvidia, the chip manufacturing company, Apple. All these companies, if you look at the net worth of these companies, they're all coming to $1 trillion, which I've informed you earlier in my earlier talk. So these companies, what they do is they ship the intellectual property rights to Ireland. They have global dealings and global sale. You take Microsoft. They sell throughout the world their software products. They don't sell it from US. They sell it through Ireland because the intellectual property rights or IP rights are shifted to Ireland. Ireland tax rate is 12.5%. Now, US tax rate is 25%. It was more than 35% earlier. They brought down to 25% today. And US also do a global taxation. US tax for various activities. But if you go to Ireland, most of the tax exemptions you get. Even people also choose not only Ireland, Netherlands, Amsterdam, Luxembourg countries where most of the like royalty receipts are exempted from tax, branch profits are exempt from tax. All these tax benefits are there. So most of the multinational corporations would like to establish their operations in these countries to save taxes. So the profit is retained in Ireland. They pay 12.5% because the IP right is kept in that country. Invoices are made from Ireland to the throughout the world. Payments are received there. Purchase and sales is booked there. Taxes are paid there. And money is accumulated in Ireland on behalf of the Microsoft back in the US. Now, what is the objective of Tier 1 and Tier 2 tax regulations are to have a uniformity of tax so one country doesn't lose out to the other country in collecting the taxes. Now, I will go into what is a multinational company. If you look at multinational companies where they have already defined the turnover of 750 million euro, which is 1.1 billion Singapore dollars, which have got operations in various jurisdictions. When you look at the $750 million, they ask you to eliminate the intercompany transactions, minority holdings, and also they ask you to calculate based on the past 4 years. Don't take into the account the current years. In the past 3 years, they look into 2 of 4 physical years to find out have they done more than $750 million. It comes into the bracket of the definition of multinational companies. Before I go into these are the multinational companies which are focused under Tier 1, Pillar 1 and Pillar 2 tax symbols. I want to tell you also briefly about what is the tax loss. All these because of not applying the Pillar 1, Pillar 2. The tax loss is MNC, multinational corporations and wealthy individuals. Due to the tax planning, countries are losing a total of $483 billion in tax due to global tax abuse. As I told you earlier, OECD member countries also like Netherlands, Luxembourg, and Switzerland are responsible for over half of the tax losses the world suffers. Because I was telling you the favorable tax positions they carry for multinational corporations. Now, how they are going to prevent this by coming with Pillar 1 and Pillar 2. The OECD countries, before I go into the Pillar 1 and Pillar 2, they come out with action plan, 15 different action plan they come out with. Actually, base erosion and profit shifting, they call it BEPS. So I will go into the 15 different types of action plans, what the OECD is looking into to prevent abuse of the global tax abuse. Action one is tax challenges arising from digitization. In fact, the OECD has not addressed about the digital taxation yet. What I mean by they have not addressed the digital taxation is that the e-commerce taxation is also not been addressed by OECD. They are trying to have a plan. They want to have a uniformity of taxation of e-commerce transactions, which is not taking place. But all the countries, member countries, have enacted their own act so that not to lose out on the tax collections. Each country has come out with how they are going to tax the e-commerce transactions. I give you an example for you to make understand why I talk about digital e-commerce transactions. There is a difficulty in taxation. Typically, any trading company or a manufacturing company or a wholesaler will be located in one country, and then the transaction or activities will be in that country. It is easy for you to tax them. When you look at a shipping company or an airline company, how government, it is difficult for you to analyze how this airline company has made a profit or losses in any transaction. I give you an example. If Singapore Airlines is flying from Singapore to US, passing via Delhi, Dubai, London, and New York, which country you are going to segregate the tax, the air travel cost, and how do you are going to tax it? To avoid the difficulty in taxation, all the countries, when they get into a double taxation avoidance agreement or DTA, they enter into, they usually in DTA, they mention that shipping and airline profits are not taxed in both the jurisdiction. So this is a common approach when they are going to define the taxing principles. So what happens is any tax treaty you look into, they talk about shipping companies, because ship also sail, like I was talking about, various jurisdictions before it goes into the final jurisdiction. Same thing happens for air travel also. So when Singapore get into a tax treaty with India or any other country, they will always say that I don't tax the shipping company's profit or airline company's profit. The same way the other jurisdiction will also exempt in the tax treaties. They also very clearly define in and DT also about how much they are going to tax for tax deducted at source, for royalty payments, franchise payments, and so on. So that these are all common cross-border transactions which you have to define very carefully, which all taken into. So I come into the e-commerce transaction to make you understand why it is difficult to tax it. Suppose a company incorporated in Singapore, having the server sitting in Singapore, software is sitting in a cloud globally, and then goods are purchased from China for selling it to Dubai or other parts of the world. The e-commerce company has got warehouses in Jakarta, Dubai, London, New York, like that. Take goods from everywhere and take the orders in the website and deliver in various countries. How do you tax these transactions? OECD has not come out with it principles, but each country, they are still working on that. I'm not saying they are not working on that. They're still working on that. Meanwhile, Singapore and various other countries have enacted their own act or included into the Income Tax Act or given outline in which how they are going to tax these type of e-commerce transactions. So OECD is looking into Action 1, which is about tax challenges arising from digitization. Action 2 is about neutralizing the effect of hybrid mismatch arrangement. That is, arrangement for being used for BEPS while minimizing impact on cross-border trade and investments. This is what exactly I was talking about. And then reducing the incentive of taxpayers to shift income from one market country to another subsidiary in a lowest tax jurisdiction. What I mean is if one country tax, say Singapore's tax 17%, India tax 25%. So you try to avoid accumulating your profit and pay tax in Singapore rather than pay tax in India. Or Indonesia taxes you 25%. You try to pay the tax in Singapore rather than paying the tax in Indonesia, whereby you save across the board 8% of tax. So these are all the duties of OECD or the member countries, because it's all government bodies are involved to decide an uniformity of taxation whereby one doesn't lose out to the other country. And then limitation on interest deductions. So net interest deductions to its level of economic activity. That means you look into the level of economic activity in deciding the interest deductions to be carried out. And then the harmful practices. Then the sixth point, they were talking about prevention of tax treaty abuse. A lot of multinational corporations try to use the tax treaty to their advantage, whereby they prevent of not paying the right taxes in the respective countries they operate. Usually, the DTA always talks about permanent establishment and taxing a permanent establishment, prevention of permanent establishment status and trying to avoid taxes. Transfer pricing. Instead of accumulating profit and pay tax in low jurisdiction and doesn't pay fair tax in higher jurisdiction. That's called transfer pricing. The transfer pricing always happens on over a country. Within the same country, transfer pricing doesn't come because if one company doesn't pay the tax, other company will pay the tax. So the transfer pricing doesn't arise within the country. Transfer pricing always comes across two countries where two jurisdictions have two different rate of taxation, and you try to use the lower tax jurisdiction instead of the higher tax jurisdiction by retaining the profit in low tariff jurisdiction is transfer pricing. Then the next one is BEPS, base erosion and profit shifting. The same thing. I mean, when I say base erosion and profit shifting is where you have got huge activity in one country where it is high tax jurisdiction, but you don't pay the fair tax, but try to pay the tax in a low tax jurisdiction. It's called base erosion and profit shifting into another jurisdiction to pay a lesser tax. And mandatory disclosure rules. That means trying to make mandatorily MNCs to disclose aggressive tax planning arrangements to avoid not paying the right tax in the respective jurisdiction. Country by country reporting. I'll come back to you. What is the advantage of country by country reporting? I'll come back to you with a chart which is coming later to explain better for you to understand. If you provide information about country by country reporting, it is easy for it to identify what are the volume of activities you carried out on a particular country and what is the tax you are paying in that country, or not paying the right tax in that country can be known if you're going to report the information country by country reporting. And then try to avoid mutual agreement procedures whereby disputes are resolved quickly and faster so that jurisdictions are working more timely and effectively and efficiently. And then multilateral instruments are there as Action Plan 15. So what is the intention of OECD is come out with Action 15 different plans to mitigate the multinational corporation shifting profit from one jurisdiction and getting taxed at another jurisdiction at a very low tax level. Now I move to Pillar 1. So Pillar 1 is, which applies to all multinational corporation where it was defined 750 million euros, eliminating all the intercompany balances. And then you apply the consistency of 4 years where they've done the past 2 years, you have consistently done more than $750 million. Will come into multinational corporations definition. And then the allocation of taxing rights on corporate profits between countries are looked into. The multinational companies always do tax planning strategies that multinational enterprises used to look into the loopholes in tax rules to artificially shift profits to low or no tax locations as a way to avoid paying taxes is what the Pillar 1 objectives are. Even Pillar 2 also do the same thing, but we look into there is a small difference between Pillar 1 and Pillar 2. I was talking to you about CBC, country by country reporting. I will give you the form to be used to provide the information. I'll come to that so that you can understand better. So all the multinational corporations have to disclose which are the jurisdictions, tax jurisdictions they operate. The 1, 2, 3, 4, 5 I've mentioned here is all the countries where they have operations. And then the column will explain how much you spend on research and development in that particular country. You look at 1, say Dubai, look at 2, Singapore, look at 3, Australia. So what each country, this multinational corporation in a physical year spent on R&D, spent on purchasing of procurements, manufacturing of procurements, sales done in that jurisdiction. What are the expenses incurred for administrative management and supply support? And then internal group finances, insurance, and then other activities to which how much they spend in that country. So what it will reflect? If you have spent most of your activities in one country, say for example in Australia, they picked up from the multinational corporations filing of this country by country reporting. They picked up a lot of companies and say that you have major activities carrying on in Australia, but you are not paying the fair tax which you should have paid in Australia. And then they have argued and taxed them for not paying the right tax in Australia. Few companies have undergone, the multinational corporations have been taxed by Australian tax authorities after they started seeing the country by country reporting. The same way, you also inform about what is the transaction you have with unrelated parties, related parties, profit before income tax in that country. The columns are there. You are going to fill up for each country. What is the income tax on cash basis, on the current year basis, accumulated earnings, number of employees employed in that, which gives you a clear picture of your activities in a particular country, and is the fair share of tax you have paid in that country or not. Now, I'll move to a country by country reporting is the major in pillar 1. Coming to the pillar 2 is about OECD and G20 have come out with on base erosion and profit shifting, whereby they have come out with they would like to have a uniformity of taxation of corporate tax of 15%. Each country has got different taxes. They are not going to apply the uniformity of taxation of 15%. It only applies to multinational corporations. They are not going to amend the tax regulations or tax rules they are following all these years, which is helpful to them in the annual budget they carry out on the tax collections. They are only going to apply the new act if they are going to come out with the new act for the purpose of this OECD Pillar 2, which is the minimum tax of 15%, which they would like to levy for multinational corporations. Singapore, in the budget in February 25, in last year budget also, they announced that multinational corporations will be taxed at 15% as per the OECD recommendations. And they have come out with Multinational Enterprise Minimum Tax Act, because to implement the 15% what they should pay the fair tax in Singapore as per because Singapore is also a member of the OECD, 140 countries in the list, for which they come out with DTT and MTT. What is DTT and MTT? MTT is Multinational Enterprise Top-Up Tax, and DTT is Domestic Top-Up Tax. The multinational corporations have to file a Globe Information Return in Singapore. So all registered multinational enterprises group are liable for multinational enterprise top-up tax or domestic top-up tax are required to file tax returns on the top-up tax liability in Singapore. They are also required to file global information return in Singapore so that they will inform you which are the countries they operate in the return, and also the, the, the tax which they are going to pay, which is MTT, which is multinational enterprise top-up tax, which they are going to pay. That means they should pay a minimum of 15% tax. If they are enjoying very other tax benefits and paying only 9% tax, they have to make it up by paying the 6% tax, which is top-up tax, which the Singapore government will be levying on them as per the OECD regulations, income in par with various countries, and then collect the 6% of tax. If you are collecting on a concessional rate of 9% tax from a multinational enterprise, you levy another 6% and make it to 15%. When I was talking about the various MTT and DTT, what do you mean by the MTT and DTT? They have come out with 4 rules. I will tell you what is the 4 rules are. Income inclusion rule, which is one of the 2 measures that allows profit or taxed at 15%, which is the motto of the OECD, to be targeted for additional taxation. The IIR imposes a top-up tax on the ultimate parent entity of lower taxed foreign subsidiaries to ensure that the parent entity consistently pay the 15% global minimum tax in all jurisdictions where they are operating. The second rule is undertaxed profits rule, which is UTPR is a second measure of the GMT, global minimum tax, aimed at creating equal taxation and operates as a backup to the income inclusion rule of 15% tax. In cases where the IIR cannot be applied, UPTR gives government the power to deny deductions or take similar actions to collect taxes that otherwise would not have been collected under the income inclusion rule of minimum 15% of tax. Also, the domestic minimum tax will be applied. Give countries the option of collecting and keeping any top-up taxes that would otherwise flow overseas. Countries that implement a domestic minimum tax are not subject to the measures imposed under IIR and under the undertaxed profit rules. Don't get confused. You don't have to worry about these things because you understand the principles of Pillar 1 and Pillar 2 is that the multinational corporations where they operate, luckily we don't have in our office multinational corporations and the responsibility to look into whether they register for GAR, Global Information Return, to be filed in Singapore, and also the payment of minimum top-up tax or domestic top-up tax. So I'm giving you this to understand what is the OECD's thinking of taxing on Pillar 1 and Pillar 2, these multinational corporations. The intention, as I was telling you, is to tax 15% for multinational corporations. If you don't pay that 15% to do the top-up tax, and domestic top-up tax will apply if any of the jurisdiction in which the multinational doesn't pay the 15% tax, you have the right to do the domestic top-up tax and collect the difference of tax also. Usually, pioneer status companies, global status companies, other companies enjoying tax benefits will all be required to pay the top-up tax to make it to 15% corporate tax. That's why Singapore has enacted Multinational Enterprise Minimum Tax Act so that they get the right and the jurisdiction to collect the minimum top-up tax as levied, as required by the OECD under the Pillar 1, Pillar 2 regulations. What is the advantage of doing this? Help countries to keep tax revenues within their borders rather than allowing them to be collected by the parent company's jurisdiction. If the company, I'm coming to the DTT, which is if a country does not implement its own DTT, another jurisdiction of the parent entity can apply the MTT under the IIR rule or UTPR rule to collect the top-up tax. That means if they operate in 15 countries, if the head office doesn't do that, they have the right for the other jurisdiction to collect the top-up tax. Now I've differentiated between the futures between the two different domestic top-up tax and the minimum top-up tax difference. Who benefits that? The domestic government collects the top-up tax. A foreign jurisdiction of a parent company may collect the tax if it is not collected by the one of that jurisdictions. Now I move on to the next topic is about POEM also is the brainchild of the OECD, whereby POEM is place of effective management. When I talked about place of effective management, I should this is a worry of all the companies, Indian companies, which are establishing their operations in Singapore. And the regulations in India, which is capital is restricted for them to make investments outside without getting because of the exchange restrictions. You have RBI, which is the Reserve Bank of India, doesn't permit capital to be taken out for making investments. So FEMA will come in. FEMA is Foreign Exchange Management Act. Under the FEMA, you have to remit the money through an authorized bank. The bank will make an application to RBI, get the approval for making the establishment of the companies overseas. And when they do it, they obtain a file reference number from RBI for the respective companies which are making investments. Typically, it's a wholly owned subsidiary of the Indian company, because Singapore may allow any foreigners to come and have 100% shareholding. When it comes to directorship, the requirement in Singapore is only one resident director who resides in Singapore. Even if that person happens to be a foreigner, if he got the immigration permission, he becomes a resident director under the Companies Act. But as far as India is concerned, due to the capital restriction, it is difficult for them to remit the money without getting through the bank, the official channel, without getting the RBI approval. But it is called automatic route, where you inform the bank who acts as an agent for you to do the job for you. They'll write to the Reserve Bank of India, get the approval, and remit the money. They will also write to RBI. When they get the approval, get the file number, and create a file for you to file the annual return until you keep the overseas companies running. Now, what is POEM? Now you know how to establish a company in Singapore. After that, the problem starts. What's the problem? What has happened is the OECD, when they talk about POEM, India adopts it very carefully. Place of effective management. The RBI, the Ministry of Finance, has issued a circular. The Ministry of Finance, which also looks after the Indian Income Tax Act, which was amended, Section 6 was amended. The provision of Section 6 says that if an Indian company, with effect from 1st of April 2016, a company is considered to be a resident in India in any previous year, if it is an Indian company or its place of effective management in that year happens to be in India. What do you mean by effective management? Suppose you set up a company in Singapore, you got the RBI approval, you got the file number opened, money is remitted to Singapore, $100,000, a Singapore subsidiary is incorporated. After you incorporate the Singapore subsidiary, the Singapore company will have a resident director as per the requirements of the Companies Act. There will be 4 directors or 2 directors representing from India. They are sitting in Mumbai and Delhi, say for example. The Indian company will be holding 100% of the shares of the Singapore company. It's a subsidiary. What is the requirement? You prepare the financial statements, get it audited, send the audited financial statements to India as per the financial reporting standard. It has to be consolidated with the Indian parent company. You pay the tax in Singapore. There is no tax payable except consolidation back in India. But what the RBI and the Ministry of Finance says, if the POEM, place of effective management, takes place in India, say for example, the 2 or 3 directors who are sitting in Mumbai and Delhi, brothers or family members or friends who have established the operations, and the 100% shares is held by their company, which they have incorporated in India. If they take all the management decision and control happens to be in India, the Indian Income Tax Act says that why I should not treat the income earned in the Singapore company is also earned in India under the Section 6, why I should not have the right to tax it in India. It's called POEM, place of effective management. Every company which have established operation in Singapore, the directors are worried on POEM. Every time when they come and meet me or when they talk to me over the phone from India, is that first basic question is that, will our Singapore company will not be affected by POEM? I have spoken on this POEM alone as a separate topic, but it's important for you to know about it. I will give you a briefing about the understanding of POEM. What is the Singapore side? Singapore, the company is incorporated in Singapore. Singapore tax authorities expect you to have the management control in Singapore. If you have one strategic meeting is held in Singapore, inform them that the directors have met here in Singapore. A strategic meeting is held about running of the company. Singapore government is happy to give you a tax resident certificate for the Singapore company. Will that sufficient for you to satisfy the Indian tax authorities that the Singapore company is a tax resident company in Singapore, so that it should not be treated that the management control is taking place in India? The circular explains in detail. I will go through the circular of the RBI about the POEM. They say that if the more than 50% of the operations, more than 50% of the staff, more than 50% of the capital are employed in overseas, we will not consider place of effective management happens to be in India. Are you fulfilling that? They also say that if the board of directors meet overseas and have the management control overseas, we also consider that it doesn't have POEM doesn't apply to them. They also say that if the company has got their own CEO, CFO, COO, has their own place of office, local staffs are employed, books of accounts is maintained, then in that situation, it is difficult to prove that the management control is back in India and we have the right to tax it under Section 6, which is the wider section now. So, to make the Indian directors to satisfy what we advise them is to fly to Singapore, make all your decisions in Singapore whenever you are in Singapore, pass strategic board resolutions, not one, more than one. One is enough to satisfy the tax authorities in Singapore that the management control is here. They are happy to issue the tax resident certificate. But if you have more than 3-4 resolutions passed, it helps you to win the battle back in India to prove that the management control happens to be in Singapore. If you also fulfill the rest of it, which I was talking to earlier, like having a CFO, staff, office space, and then books are written in Singapore, strategic decisions are made in Singapore, is good for you to convince that the place of effective management and control happens to be in Singapore. Interestingly, some of the auditors in India also advise these companies' directors who operate their business in India, also having a subsidiary in Singapore, to have more than one director in Singapore so both of them can meet and pass all the management decisions and control, whereby to prove that the management control is in Singapore, not back in India. It also depends upon the company's operations and whether there is a need to have more than one director, to have a second director in Singapore to carry on the activities of the Indian company. I don't have anything else to say on this topic. I have covered most of it. I feel that thank you for listening to me. I'm happy to take more questions from you if you have any burning questions. Thank you. Oh, transfer pricing is a okay. I give an example of transfer pricing. So Pavitra Kumar has asked me about transfer pricing. Okay, you buy a goods from China for $100 and sell it to India for $140. That means $40 is retained in Singapore. India purchases $140, sell it at $145. Indian taxation is 25 plus plus. Singapore taxation is 17. So the major profit is retained in Singapore of $40 and India pays tax only on $5. Singapore pays 17% tax you pay on $40. This is transfer pricing. Did you sell at the right price? Did you sell at arm's length? If you do not have your own company, if you sell it to a third party, that guy will buy from you at $140. He says that I will only buy from you at $120 and he will make a profit of $25 by buying at 120 and selling at 145 back in India. This is transfer pricing. So this all happens usually with related parties. That's why in Singapore there is no transfer pricing act, but there are transfer pricing guidelines are there. And you in your notes to accounts, you always mention if you do more than $15 million of transaction, usually you disclose everything of any any related party transaction in the notes to the accounts. But the transfer pricing guidelines in Singapore ask you to maintain and justify why do you sell at this price if the transaction exceeds with the related parties more than $15 million. When it comes to services like rental income, commission, interest payment, more than $1 million, you have to maintain the documentation for the purpose of disclosing to the transfer pricing officer. In India, there is a Transfer Pricing Act. A lot of countries have got Transfer Pricing Act. There is a Transfer Pricing Officer also over and above the Income Tax Assessing Officer. In Singapore, the Income Tax Officer also look into transfer pricing. If there is any transfer pricing has taken place without justification, they have the right to tax you on the profit which should have been taxed in Singapore. But usually it doesn't happen in Singapore. It's a vast subject. Transfer pricing is a vast subject. It's a separate chapter. You have to be careful, but luckily we haven't come across a lot of transfer pricing cases in our office because Singapore being a transit place, it is difficult to know whether the transfer pricing is taking place. How they handle transfer pricing is a different ballgame. I can talk to you. It has to be taken up as a separate subject. Any other questions you have? Transfer pricing also take place in expenses also. I told you it's always takes under two different jurisdictions. That means you dump expenses of some other country to Singapore to pay a lesser tax. It's also transfer pricing. One is profit shifting, other is dumping expenses also in transfer pricing. Any other questions you have? If you do not have any questions, I can close the talk today, and thank you for joining and thank you for being with us. Thank you.
Thank you, sir.